Well, welcome in, Jim. How you doing?
I'm doing well, thank you.
Glad to have you here again, the first repeat guest.
Yes, I was hoping to be the first repeat guest.
Well, congratulations.
Thank you. And now I'm going to earn my shirt.
Yes, earn your shirt. Yeah, I think we started giving out shirts after you were the guest, so you will definitely get one today. And they're extremely soft, so hopefully you enjoy it.
I will wear it all the time.
Excellent.
Just depends on what you're doing. If you're doing something like nefarious, please don't wear it.
Of course not.
Yeah.
I wear a different company's shirt for my nefarious actions.
That's good.
On the back of the shirts, we could put like the bumper sticker from the semi trucks, like, "How's my driving? Call this number." Like,
Yeah.
"How's my conduct? Call this number." All right. Well, I wanted to have you back in because you and I met a couple weeks ago, and we kind of got into, I don't know, I guess a little bit of an in-depth talk about economics, kind of, and where you thought the economy was going, and you're taking on some new strategies as far as what you're doing with the multifamilies that you did own, and the things that you're getting into some different kinds of investments, both real estate and outside of real estate. So I just wanted to have you in again, and just kind of everybody knows the economy might be on the edge of a correction or something, and so that's kind of part of what we want to talk about. But just kind of get an update on what you're doing and why you're doing it.
Okay. Yeah. Great. You want to start with the economy?
Let's talk about the multifamily.
Okay.
Just because that's kind of front and center for all of us right now.
That's easy. I'm selling all my multifamily. I sold. I had 3 properties, which were I think 34 total units. I sold my 8 unit at the end of last year. I sold my 4 unit at the beginning of this year. And as you know, we are in contract, or soon to be in contract, with you guys to sell my 22 unit. Part of the reason I'm getting out of the multifamily is, well, there's two main reasons. One is the market. You can get pretty good money for these compared to 3 years ago when I bought them, and also the performance, the cash flow wasn't what I had expected when I got into it. And I think there's a few reasons for that. I think if I ever did multifamily again, I'd do it differently. I would buy and make sure that I got rid of everybody and just did it up, and fixed all the units, or something along that lines, where I've been just trying to preserve and keep tenants at all costs because I wanted the cash flow immediately. So I think I didn't put enough aside or realize that that the unit turns would cost so much. I was kind of told, it'd be about $5,000 a turn. It's been $8,000 a turn. So it's hard to make money that way.
Right.
And I've been thinking about this. I guess I compare it to, I was thinking about how you buy a stock, like you buy a share of stock from a company, Apple or whatever. And when you buy it, you hope to make some money, but someone's going to lose on that transaction, right? There's got to be the other part. If you're winning, they're losing. And that's kind of how the stock market goes, where this transaction I was thinking a lot about between us is you're buying my property. I'm going to make some money compared to where I bought it. But you're going to be able to make money also because you can do a lot of things with that property that I can't do.
Right.
You're not going to have a management fee. I know you're going to have management expenses, but not the fee. You're going to be able to do the rehabs at lower cost. I mean, there's a lot of cost efficiencies that you can do that I can't do. So a lot of this real estate, and why I like the real estate, is it's a win-win transaction. Right? If I was going to sell you my shares of Apple, it'd be me winning and you losing, or if it was a good deal, it'd be the opposite. But with real estate, you can, and that's why these meetups we have works well, because you can really help other people.
Right.
I'm curious to know why you think, if I'm willing to buy your Apple stock and you're willing to sell your Apple stock, why do you think I'm losing and you're winning?
Well, it could be the opposite, right?
But why isn't it win-win? If we both are voluntarily going into that transaction, and I think it's good for me at the price you're selling, and you think it's good for you at the price you're selling, how is either of us losing?
Well, I guess you're not losing in the transaction. I guess the way I think of it is, if in the future,
In hindsight, yeah.
In hindsight, we're going to look at that and go, oh, that was a better deal for you than it was for me. If it goes up, I'm going to be like, ooh, I'm glad I sold. He lost, or the other way. If it goes up, I'm going to be mad that or upset that I sold.
Yeah, but potentially you already are making money, so it's good for you now because you bought it at a lower price.
Yeah, I guess.
So to me, it's not. It's a win-win, and it could be a lose for the buyer because the price might go down, and it could be a win if the price goes up. So it's a little bit. I think it's a little bit. I just don't like the wording of it's win-lose.
Yeah, you're
because
probably
we're
right.
voluntarily going into the transaction.
That's true. It's not that black and white. I guess the just to contrast it to what we're doing on the real estate transaction, that feels to me, because when selling to somebody I know, I was a little bit nervous about that because I don't want that to get in the way of, other relationships,
Sure,
like if it
sure.
goes bad or something like that. But then I thought, and John brought up when we were talking about the price and what to do about how to sell it, he brought up some efficiencies that he's going to have that I don't. And I thought, okay, that's just a win-win. And you can, almost all the real estate transactions you get into, you can maneuver them so that they're win-win for everybody. Where, the stock market has so many other things. You're not in control of the asset.
Yeah, right.
There's these micro trades that go on seconds before you do your trade. So there's so many inequities.
Right.
And there's a lot of other reasons why I'm kind of down on the stock market these days. But it just seems to me it's not as easy to get a win-win. It might not be a win-lose.
Certainly not. I like what you said. It's not I can't control as many variables.
Right.
Whereas in real estate, we can control a lot of what's going on at a particular property. I mean, we can't control the demand for the property, maybe a little bit by how we rehab it. Right. But, the other owners around us, we still can't control them. And so there are some things out of our control, but there's more things in our control than if you just bought stock in some company.
Yeah, and that's why I've transitioned my whole financial world really away from paper assets into real assets. And then there's various degrees of control. If we talk about syndications a little bit later, I have very little control over the syndications. But the real estate that I actually own, I have more control. But in all of those, I have much more control than I do over how Apple does their operations.
Absolutely,
Sure.
yeah.
Oh, you could buy Apple products once in a while.
That's true. I do
bumps
that.
Your stock price up.
Exactly.
Yeah, and so in this circumstance, and when Jim and I were talking about it, it's because Brian and I are very involved. We're very can you think of the word? I guess active investors.
We're active and we're all in. Like we really are committed to the success of it because it's our financial futures.
So when we have an issue with one of our properties or a multifamily, it's brought to our attention. That may become priority one, right? Whereas when you hire a property manager, you have somebody managing your properties. Something comes up, that's probably the 10th thing that day that comes up, whether it's a tenant who's getting evicted or somebody moves out or damage or something like that. And so Brian and I obviously it takes more time than being passive, but that's what we do. And, we have an entire infrastructure with employees that take care of all of that. So.
Right, and I think that makes a big difference in the kind of property we're talking about, especially because it needs more care than and focus than it was given. And that's not my property manager's fault. That's just the way it is when you're trying to be passive. And my goal was cash flow. So I was just scraping, anytime they would want to evict somebody, I would, no, don't evict unless you really have to, because I wanted the cash flow. And that's one thing that I've learned is you just got to up front, you got to set the property, set the expectations, and do it right from the beginning instead of, trying to skimp along the way, which is kind of what I was doing. I was trying to make it work and make it cash flow without fixing the problems that it had.
Right. And if you think about it, you were getting maybe a little bit more cash flow at the time, but the truth is that the property would be worth more today if those tenants would have turned over a year ago when issues came up, right?
Yes. Oh,
so if the property was 100% occupied and everybody was at the the very top of the market for rents, the property might be worth an extra 100, 200 grand, maybe something like that, right? So
and that's where you have a little bit more control, I think, especially in multifamily, is really getting the rents up increases the value. And we have 12 units over on the south side, and we've been looking at the rents this week. We've owned them, I think, a little over a year now, and the 12 units, we still have 3 tenants. So we've got the rents to like $725 in 8 of the units, and 3 or 4 of the units we have at $575. And I'm like, what? We've had a year plus here. What's going on? Why are we still have these tenants that haven't increased their rent? Those properties or those units probably need some rehab. So we're really made it a priority at the first part of this year that those 4 tenants need to get their rents bumped up because we want to refinance, and the refinance is going to be based on how much income we can bring.
Right, and those are things that you're looking at actively, and I was kind of just looking at those passively. Like, okay, this I know I can rent it for $650 now, a new unit, and someone's paying $500. But if I get them out of there at $500, I try and raise rents and they leave. Now I got $8,000 that I'm gonna have to put into it.
Right.
And because I wasn't running it necessarily as a business, that $8,000 is coming out of my pocket or the cash flow that I'm not getting. So I would say, well, no, it's going to take too long to make up that $8,000, so I don't want to do it. Right. So it's just a different perspective. And so that is actually coming to that realization is what made me more comfortable with doing a transaction with somebody that I know, is that, okay, I came at it from a different perspective. You guys will have more success with this property than I did because you're coming at it from a different way.
I think that's the hope.
Yeah.
That's why we're going into it. We hope it's a win-win, but there's some speculation, I feel like, in there.
Yeah.
I mean, the building next door has a tarp on the roof, and we
them.
don't have any control over what that owner does with that building.
Right.
We can dress up these buildings. We can make them look a little bit nicer, but it's going to cost a significant amount of money to get there, I think.
Yeah, no, I agree with that. We're all hoping for a win-win, but as soon as I get the check, I don't care. I'm just kidding.
Well, I was going to say, too, you said, you might go out, if you could do it again, you would go about it maybe a different way and try to turn everybody over. And there's a balance to that, too, because we bought a 16 unit out near Newark, a little further east. And, we were like, man, we're going to clean this place up. We're going to raise rents. And I think we posted notices raising rents and basically saying, if you want to stay, you're going to have to pay these higher rents. If not, you're going to have to leave. And like half the tenants left out of the 16 unit. So for us, like, I think.
And we're almost back a year later. We're almost back to full occupancy, but it's been a rough go.
And we were able to rehab all of those units, and now we're getting top of the market rent, which is good. But still, it was a lot of cash outlay to rehab 8 or 10 units at a time, and we didn't have any income or very little income during that time either. So I think if we were to do that again, we would maybe do it kind of incrementally,
just do one building at a time. That place had 2 buildings. Right. And I think that's our strategy coming up. But there's 6 buildings over here, so we're probably going to do one building at a time.
I think that makes sense. And, I still think multifamily is a great asset. I'm just doing it in a different way now. And that, again, the syndications that we're talking about a little bit later are how I'm going to get my multifamily. I don't think I want to own a large building and manage it myself or have a property manager own it. But owning it as part of syndication, I still get the asset and I still get all the benefits of the real estate. I just have a little less control, but I'm still getting a return.
So let's talk about that. You've been doing a little bit of this or something similar to syndication, maybe not exactly syndication. So I guess what have you been doing, and what are these goals that you're talking about for the future?
Okay, well I'm involved in quite a bit. So we started with another guy. I guess it's a real estate company. It's not really a syndication, but it kind of is. We have 10 investors. They contributed money, and we went out and from I think September to December we bought 9 single-family homes of different types. Well, I guess there was a couple more. There's a four in there. And the goal, or the reason we did that, is partially because I'm a financial advisor, and some of my clients have done everything they can do, and they want to get into real estate, but it's very hard for someone to get into real estate who has a W-2 job and works a lot, but they have a lot of money they'd like to deploy. And some of my family members also. And so we developed this company as a way to get them to get into real estate and get the benefits of real estate without having to do a whole lot. It's fairly passive for them. And then me and the other manager, the other guy basically found the properties and that, and I kind of do the books and the backroom stuff. So the properties we got, I think we really did a good job. We're going to have hopefully 10-12% return over the first year, I think, once we get them all. Some of them need light rehabs. There's no full rehabs, just light rehabs. And so I really like that model. So that's one thing I'm into. The syndications we talked about, there's a ton of different syndications out there. And basically what a syndication is when someone goes out and raises money and then they have an investment they want to go out and buy. So a lot of these are larger apartment complexes, a 200-unit apartment complex, and the minimums are you got to put in $25,000 or $50,000, and then or $100,000 depending on what the deal is. And so there's a couple that I'm into now. They don't really have a preferred return. Most of these are like 8 to 10% preferred return. This one they call it the infinite return model, and what they do is they don't the sponsors don't take a cut until all of the capital is returned to the investor. So you put in $50,000, their goal within 2 to 3 years is to have returned the $50,000 to you, and then you still own the asset, and then the investors get 60 or 70% of returns going forward, and the sponsors get the other 35%.
So even as the investor into the syndication, once you get paid off, you still own that percentage? Okay.
Yeah, so you still own the same percentage.
And you still get the cash flow every quarter or whatever that at your percentage.
Yes.
And then whenever they sell and their exit strategy is maybe 7-10 years down the road, you get your percentage of that profit as well.
Exactly. And there's different degrees. You might not the owners take a little bit larger cut because they forego the first few years of taking anything. But and they might refinance out of it or they might sell out of it. It depends on how they do it. But the goal is to get your capital back, and then you own a share of that and get the cash flows from it. So it's a pretty neat way to do it, I think. And that's where I'm getting my multifamily exposure now. I just got into one in Dallas, and I'm into another one in Houston.
So recently I started looking at some of these. There's a guy that I met. I had listened to his podcast. I forget the name of the podcast. I think it's How to Lose Money or something like that. And he and his partner, they do syndications. And I started researching. So there's a lot of different websites, and this you have to be an accredited investor for some of them. Some of them you don't. And there's a pretty, it's fairly complicated to wade in and figure out all the details because every one of them does them a little bit different.
It is. And the thing I've learned, and because all of the real estate I've done, none of it has been my due diligence really, except for the numbers. I'm a numbers guy, so I have 20 Excel spreadsheets that'll proof out the numbers. But I've been relying on other people for everything. I met a realtor who manages properties. I bought a couple properties from him, and now those are my rentals. I met my property manager for multifamilies and trusted him and bought some properties with him. I've been listening to podcasts. I went to a seminar that one of the podcasts did, and I met some people there, trusted them, started doing syndications with them. For me, it's I find people that I know, like, and trust, and then that's where I put my money. And it is hard with the syndications, but I did my first syndication, and then that person introduced me to a couple other people, and now I have a network of people that I know and trust and have shown results. There's I have private lending that I do on some office buildings in Dallas. There's a lot of different things that I'm doing, and it's just that if you know and like the person and trust them, then you can give them your money, and you kind of start small, and then you see how it goes. And not to get too far off on a tangent, but that's where I'm going with this TribeVest thing. We had TribeVest was a speaker at a networking event, and what they do basically is they allow people to come together and invest together. And so what I'm doing is putting together a couple of different tribes for some people that have significant money they want to put into real estate. And so what we're going to do is put the money together, and then we have these syndications, and I'll go out and find the syndications, and then we'll invest together. Because these syndications have minimums of $25,000 or $50,000, so it's hard to write that out of your own pocketbook all the time. But if you get 4 or 5 people together, you can do a couple of these a year. And part of what really helps with is you buy these syndications, you still get the depreciation. So every year you're kind of starting that clock again, and that helps with your taxes and all that other stuff. So that's one of the things I'm really pushing, is to try to get these tribes going. And the TribeVest just makes it easy to put an LLC together and do everything online, so everyone can see what they're doing and be involved. So I'm pretty excited about that also for the syndications.
So as a financial advisor, is that you're allowed to, I guess, get your clients involved in something like that? Like
No.
No, okay. So these aren't your clients that you're creating tribes with?
They are, but I've given up my most of my licenses for financial advising because I want to do this. So the problem, there's a big conflict of being a financial advisor and then being interested in alternative investments, right? I'm not a big stock market guy anymore, and I'm interested in all these alternative investments, but I don't make any money off that when I get. That's why a lot of financial advisors don't recommend real estate and hard assets, is because they don't get paid, which makes sense. But I want my clients to do the same things that I'm doing, that I believe in. And so that's why I've kind of changed gears, and I'm more less financial advisor and more kind of just helping people manage their wealth. And so these syndications is an easy way to do it. They have good returns, and they really help people. Because if you have a high W-2 income and you can transfer some of your wealth into real estate, then when that wealth earns money, it earns money at a lower rate, and really you shouldn't pay
lower
much
tax rate.
Lower tax rate. And so instead of putting it into the stock market where you're not earning that lower tax rate necessarily, real estate, you can almost erase the taxes that you pay on at least that portion. So the more W-2 income you convert into hard assets, the less tax you pay, and that's really how you win, is the less, lower your tax rate, the better off you're going to be.
Right.
So are you, and we don't have to keep this in the recording or whatever, but are you making? How do you make money off? If you're giving up all your licenses and you're not helping people invest money where you would made money that way, are you making money organizing these syndication deals? And
Yeah, so like one syndication I'm doing, I got my sister into it also. So she's going to invest in side next to me. So the company for bringing her to them is going to pay me, I think it was $500. So I'm not earning a living that way.
Okay.
And that's not really my goal. But with the tribe vest, what I'm thinking about, I was trying to think of this, and the guys in my tribe, I said, look, I need to be compensated in some way because I'm the one that's spending the time going to these conferences. Like tomorrow, I'm flying to Phoenix for a conference, and I'm the one finding these investments, and you guys are just kind of hanging out, collecting the money. And they're like, yeah, you should get paid. So we're still trying to figure that out. What I think we'll do is, if we have a group of 4 and everyone's putting in 25%, maybe I'll collect, everyone will give up 1 or 2% on the return side, and that'll come to me as
a management fee.
Yeah, as a management fee. So I am not looking to replace my financial advising income with income from this. I'm looking to invest alongside people and just turn into a full-time investor and earn money that way. And then, as I'm sharing my resources, I'll get, work out compensation agreements with people, but it won't be like a huge part of it. It'll just be,
sure,
hey, he did this, we'll throw him a little bit. Because I don't want to take too much of
the dog a bone.
Exactly. I don't want to take too much from the
investors. Yeah, I mean, that makes it lose its return, lower its returns for sure.
Right.
I think it's funny. When we were talking about multifamily, you said if you were ever to do it again, you wouldn't manage it, you would just invest in a syndication. But here you are kind of creating your own syndication where you're taking other people's money. And like you said, you bought 9 houses and getting returns on those. And you're kind of getting other people to invest. So like you're kind of managing something, just not the multifamily itself.
True. And I guess I'm doing everything in a different way. And, the group that we bought 9 houses with, I really relied on someone I completely trust to find the houses. He had someone he completely trusts to manage the houses, and they know a lot more than I do. So I part of the reason I did is because I wanted to try buying some houses on my own with my own expertise instead of always relying on other people.
Right.
And so I learned a lot from them. And what I learned also is that if I want to buy one of these properties similar to what we put in the group and I want to buy it for myself, I'll probably just rely on them and have their help again, right? So why go learn all this new stuff and become an expert in it when I'm not going to do it often enough? Like, you guys have to know how to do that because you do it every single day. Well, if I'm going to buy one property a year in this way, why wouldn't I just rely on the people that have already done it, already know how to do it? And that's why when we were talking earlier this year, I said, I want to maybe buy a couple properties from you guys this year because I'm not going to send out mailers. I'm not going to do all that stuff.
Right.
And I have to realize that I don't want to manage properties. I want to make money from real estate. So, everyone's got to find their own way. And I'm really into sharing this with people. And so that's why, I put together the group where we bought the houses. I'm doing this Tribe Vest stuff because I know it'll make me money, but I'd also like to help other people learn how to make money and get their money in places where even if they don't have control of the asset, like you don't really have control of the asset in a syndication, you at least have all the benefits, the depreciation, the leverage, all the stuff, all the good stuff that comes with real estate,
right.
Instead of just buying a piece of paper and hoping that it, appreciates. I mean, I was listening to a podcast the other day, and the guy had a pretty good point. In 2008, when the meltdown happened, right? Let's say one day before, I think he said Lehman Brothers was the one that really kicked it in. One day before they went under, all the stock market was at whatever price it was at. The next day was half that. But the underlying assets, nothing changed.
Right.
But everyone lost all of this money. But if one of my houses devalues by 50%, I still have a tenant in there who's paying me rent.
Right.
So my income doesn't change. So I'm not as into, especially as I get closer, hopefully, to retirement, I'm not as into what are my assets worth. I'm into what are my assets produced, what kind of income are my assets producing. Because that's all that matters. I don't care what how many assets I have. I care how much income I have from those assets.
Right. So that's really your change in mindset as far as you said you don't really invest in the stock market anymore. And that's pretty recent, right? I mean, last year, like you had money in the stock market and you're kind of pulling a lot of it out to invest in these alternative investments. And is that the main reason? Or, I mean, do you see kind of an economic hiccup coming or correction or whatever you want to call it?
I mean, I'm not an expert by any means, but I do. I think I do and I don't because when I think of, there used to be a business cycle, right? And that was a normal cycle where things would go great and then they would kind of crash a little bit. Well, now the Fed is so concerned about not having a crash that they just print all this money. So now there's a credit cycle, right? And so in 2008, it kind of exploded, but they didn't fix anything. They didn't let anybody, a few people went under, but they rescued everybody, right? So now it's even worse. There's huge credit. I saw that car loans have the largest delinquencies, three-month delinquencies they've had in 10 years. So there's something to that. That doesn't mean everything's going to crash, but there's something to that. Colleges, the price of tuition is going up like crazy. And why? Because there's so much money available for people to get loans that then you graduate after having, $100,000, $200,000 in loans, and you're a teacher making $40,000. Well, it's going to take a long time to pay that off. And I saw somewhere they showed the amount of student loan by age, and there's people that are in the 50s and 60s, like 5 to 10% of the population of that age has student loans.
Wow.
And those people weren't even around when this easy money of college loans go. So there's this big debt bubble.
Right.
And something's got to happen. Either we have to inflate our way out of it, which means, inflation has to go way up so that it's easy to pay off that debt, or something else. I don't know what. So I was pretty negative until I read a book. I brought, the name is Upside, and it's about demographics. Right, and it's really interesting. The baby boomers, everyone knows about the baby boomers, the biggest generation ever, right, until recently. But they've really done a lot to make this whole economy go for the last 40 or 50 years, right? And so the example this guy gave in the book was there's this company, an Indian motorcycle company or something, and about the time the baby boomers were 20s, 30s, they were just doing great. They were making a ton of money, and then all of a sudden, a few years later, everything changed. They just started losing money. And they thought, no one likes motorcycles anymore. And then this guy did some research, and what he found was Generation X came through. And Generation X is so much smaller, by 4 million people, that they were selling maybe the same ratio of motorcycles, but there were 4 million fewer buyers.
Gotcha.
So that whole thing went through the economy for everything, right? So now the biggest generation ever is this Generation Z or millennials or whatever you want to call them, but they're just about to come into the economy and do what the baby boomers did, only they're bigger than the baby boomers. So I'm hopeful that part of that will maybe save some of the problems that we've created with this debt cycle and this other stuff, is that there's been this lag or this lull of Gen Xers not doing much because there's so few of them, right? And so that's another thing that I think about, and that's why, I think the U.S. with a lot of we are having babies at less than replacement, right? But we allow a lot of immigrants in, and so I think when you look at Japan and Germany and some of those countries that are also having births at less than replacement, they're going to have issues. In China, for sure, with the one-child policy. So this demographic book really opened my eyes to, the U.S. is still going to be doing okay, I think, because of that, where there's going to be some problems in other places. Like, India, I think, will be great. China's going to have some problems because of their demographics. And if you look at everything from the demographics, it's, especially for real estate, things look great.
Right.
But I ramble on when I talk about
that. Yeah, I think
so
one of the things that's interesting, I think millennials, one of the reasons why we like having rental property is a lot of young people, they don't want a house that they have to take care of. They need somewhere to live. And, I think there's more of an urban, so that's why you see a lot of these multifamilies going up in downtown areas, and people they like the close-knit community. And so there's a lot to that, I think. I think millennials also have a significant amount of debt given college, so I don't know how that all balances out, but
right.
But there's definitely I think some good upside for people that have rental property.
Oh, I agree too, and so many people in their 20s out of college now are living with their parents, right? And that's fine for a few years, but once they start creating families, having kids, they're not going to want to live with their parents anymore, and because they have all this debt, they might not be able to get a loan to buy a home, so they'll be renters, and I think that's great for us. I think the fact that with the I just stumbled. You can erase this, right?
No, we're live.
I just lost my train of thought. But the fact that they can't get out of the house and get these loans, and the mortgage industry is not like it was in 2007 where they're giving loans to anybody. And that's, I think, one of the things that's going to stabilize the real estate industry is that prices have gone up, especially on the coast and even here in Columbus and other places. But the loans, it's still hard to get a loan. It's a pain in the butt. I'm in contract on 2 houses right now, and and getting a loan, they're asking me all kinds of crazy questions. I'm like, I just did a loan with you in December.
Yeah.
It's February, and so I think that's holding some of the real estate prices down a little bit.
Right. I guess I see when we sell houses, like when we sell house FHA, like I see the opposite thing. I mean, we've had multiple transactions where they have to adjust the settlement statement because the buyer's getting money at closing. So I don't know, maybe I guess how easy it is to get a loan, but it sure seems like, I mean, we have a lot of properties that we sell where they're asking for $3,000, $4,000, $5,000 towards closing costs, which obviously closing costs don't cost that much. So
Right.
that money is just going towards the down payment of their house, which to me seems absurd. I
mean,
mean, maybe it's just FHA, and I don't know what percentage of FHA the loans are in the U.S., but
Yeah, I mean, we've seen a fair amount of that where people don't have to bring hardly any money to the table when they get, especially on the houses that are like 150, 125,
Right.
$100,000 houses.
or they're in contract. We've had this happen. Or they're in contract to buy the house, but they can't afford the appraisal, like the $300 appraisal. And we're thinking, well, how are you going to come up with a down payment if you can't afford $300?
And how are you going to fix the furnace when it dies?
Yeah.
Yeah, that's interesting. That is in contrast to what I'm experiencing, and I guess that I'm an investor, so I'm on my 10th investor loan, and if they're more strict on those than they are with the new home buyers, that is a little scary. But I still hear that the mortgage industry is not doing what they did before. Right?
I do think there's a lot more diligence required by the lenders.
Yeah.
I do think that these people, we've had multiple transactions that have dragged out over time because there was a question in the person's finances that they had to bring some supporting documents or something. So they're definitely not doing these sort of documentless loans anymore that they used to do.
They're fraudulent appraisals and things that were going on.
and that's some comfort that there's. I don't like the overregulated stuff, and it makes some of the transactions difficult. But I also don't want, like it was in 2007, because I think that really caused everything to just implode that much faster. And I don't think that's going to happen this time. I mean, the loans that we have problems with aren't the mortgages; it's the other loans that don't have anything backing them up. There's no asset backing up your college loan, or I guess there is for your car, but those and the credit cards. Those are the problems, I think.
Right. So when exactly is the collapse going to happen?
Yeah. Good luck with that.
I'm kidding. You turned me on to a book called Prosper that I'm probably about halfway through now.
Yeah.
And maybe it changes after the first half, but the first half is definitely kind of doomsday, very much, buy canned foods and, buy precious metals. And
Oh, yeah.
it's very
Get a food
interesting. though.
dehydrator.
Yeah, I thought about going out and buying a farm after I read that book, and it is doom and gloom. But
Yeah.
I think what it opened my eyes to, because eventually I recovered and thought, it can't be that bad, and if it is, okay, we'll have to deal with it. But some of the things that I liked out of that book are that resources are finite, and the earth has finite resources, but the economy is expected to grow at 4% forever.
Right.
So you can't have, an infinite growth model on a finite resource. We are going to run out of oil at some point, and that book also opened my eyes to oil as everything, right? You need oil to transport anything and to make anything. So if we don't have oil, that we're going to have to. And his the guy that wrote Prosper, Chris Martinson, his idea is you can't invent your way out of everything. I think that's what everyone's hope. Well, we'll just invent something, and maybe we will. So, you got to read something positive or hang out with your kids after you read that book to kind of reverse the the depression of reading it. But I think it opened my eyes at least to, there's some other things going on out here that we have to at least pay attention
Well, isn't
to.
this? I mean, this is the whole field of economics. I mean, economizing, because resources are finite.
Yeah.
And so this is why we even study the whole field of economics, is because you have to economize the resources you have, because they're not forever.
Right, but businesses and government aren't looking at it that way. When they see this guy saying it's peak oil, they're like, no, we got all this oil in the shale fields. Well, if you talk to I don't know anything about oil, but this guy, he says if you look in the shale fields, they say you can produce X, and all their estimates for infinite oil are based on X. And he says what they actually get out of shale fields are half X.
Right.
And all this extra energy is needed to get to it.
Right.
So you're burning oil to make oil, and it's not.
Right.
It just the numbers don't make sense according to some experts. So,
Well, isn't that why the government they go through the whole subsidizing corn to make ethanol, and it costs like a gallon to make a gallon, and so it's like net zero, or it even might be a little bit net negative, but they're still subsidizing it.
Right. Right. And the author's point really is you need to just be aware of this stuff and be protecting yourself in many different ways. And that's kind of the gist of the book. And I liked it. I haven't done all of the things he recommended, but I've thought about them. And so I think that puts you in a different position when you're thinking about things differently and you're not just going along with everybody. And I think that's, especially when we get back to me being a financial advisor, people, the way people handle their finances is they just do what everyone else does. And they have no idea if a 401k is a good thing or a bad thing. Everybody does it, so I do it. And I don't want to be that guy. I don't want to do what everybody else does. I want to do what makes sense to me, what makes me money, so that I can have freedom, right? That's kind of my feeling.
Right. That reminds me of, I think I read a book a couple years ago. I think Brian read it, called 1 Second After.
Oh, geez.
It's like a doomsday book of like an EMP hitting the U.S. and there being no power, basically. I remember after that I went out and bought a bunch of canned foods and kind of put plans together. Not a lot, but enough to last like a couple days, I guess.
I always talk about going out and buying bottled water with my wife. We gotta go get some bottled water and put it in the basement. We never do, but I just think having some of those conversations, like we finally, after I bought Prosper or read it, we went on Amazon and bought like an emergency kit for $50 that we threw down in our basement just in case.
Oh yeah.
I don't remember what was in it, but flashlight and maybe a knife and
a bug out bag.
Yeah,
right.
Yeah, and a roll of duct tape or something.
I've thought about stockpiling bullets, and I don't even own any guns, but I feel like that's going to be a currency if everything collapses, right?
Oh, for sure. I did buy some gold after that book too, just to have some. I'm
not.
Where
in your house? Where in your house do you keep that?
Oh, it's not in my house. It's in your house.
It's buried in the
backyard
yard somewhere.
Yeah. Right.
Starting to sound a little bit like Glenn Beck in here.
Yeah.
So you have some other alternative investments that are interesting. You want to talk about those and maybe how they're structured?
Yeah, so I talked about the apartments. There's the, I think I talked about this last time, the coffee and chocolate farms. Did I or not?
I vaguely remember it, but maybe you can just refresh our memory.
So there's agriculture is something that isn't anywhere in my portfolio, or it wasn't until, again, I met some people that they have in Belize, they have a chocolate farm, and in Panama, they have coffee farms. And so
these are the same folks, or there's two separate?
They're affiliated. Yeah, they're
okay.
affiliated. So with those, the idea is those are always going to be popular products, and you don't get any return for a couple of years, but then afterwards, you just get regular returns for years and years. And it's kind of one of those legacy things that, they're not that expensive. You can get a half acre, I think, for $25,000, and it's all turnkey. As you know, most of the stuff I do is turnkey. I just passively do it. So they have a whole operation. And the nice thing about these is they're also socially conscious. So these farmers were barely getting by. They buy up the farm, and then they train them. They give them better technology. They give them housing. They pay them a better wage. And so it's kind of everybody wins is the idea. So I really like those investments. We actually my wife and I went down to Belize to look for some property. We were doing a little bit of that also, and we tried the chocolate, and it was pretty good. So
nice.
So those are kind of cool.
Sounds like fun.
Yeah, we're not making money on that yet. But a couple others, I did lending for marijuana farms in California and Oregon. And so
where it is legal.
It is legal there, yes. And so that again, they have to build all the stuff first, so you kind of get paid. It takes a while to get paid, but there's 15% return on that once they get up and running and get their stuff going. Most recently, I did CBD. Have you heard of CBD? It's they make it out of hemp, and I guess it's It's kind of like marijuana, but it was just approved by the government. It doesn't. It gives you the benefits, some of the medical benefits they're talking about for marijuana, but it doesn't get you high. And so the company that I was doing office buildings in Dallas started a company that they're extracting CBD, and so that was a kind of a neat investment because you can lend them money, and then once they get it up and running and the company is going, they're going to perhaps go public or offer shares, equity lines. And so if you lend to them, then you can get in on the equity on the back end. And those are 12-month loans, and they pay 12%.
Oh, so they pay you back at the end of the 12 months.
Yeah, and as soon as you give them your money, you start earning the 12%. With a lot of these, you don't earn your 12% until they close on the deal and get started, so it's a couple months. But this, actually, they pay you once they get started, but they pay you back for the time you miss. So
Gotcha.
It's 12% from the beginning, which I really like.
Huh.
I I did Mobile Home in Alabama. Again, that was a syndication I just bought part of, and then mobile home lending also is something I'm involved in.
So you're looking. Sounds like you're like kind of between like the 10 and 12% interest rate on most of these alternative investments.
Yeah. Some of them go up as high as 15, but most of them are 10 to 12. And some of them are the lending I like because it's 12 to 18 months. I do it out of my self-directed IRA, so I don't have to worry about feeling like someone has my money for, I can't do something else. Because I did one loan out of my non-self-directed IRA, so I was always antsy. Like, well, what happens if I want to go buy a property? I have this loan out and I can't get it back until they're done. So and also for tax reasons, I like to lend out of my self-directed IRA, and now all my equity positions I'm doing out of my taxable investments, because then I can depreciation
Sure.
all the tax benefits.
So is that 10 to 12%, is that just like the perfect balance for you? I imagine you can probably get higher than 15% returns, but there's going to be a little more risk in there. Have you looked at any investments like that?
I haven't found any that are much higher return than that, although the apartment buildings that I was talking about earlier, they don't promise those returns, but their historical returns have been 20-30% annual. So I'm hoping for that. But for the other syndications, especially the lending, there's no upside. It's just 12%. It's just 15%. It's just there's that
annual. Yeah.
It is what it is. But that's a nice place to put money for 12 months, and then you get it back. There's also one that I actually am investing in. It's called AHP Servicing, and it's a place I just stash cash, and they pay you 10%, and you can get it back anytime. It's like a bank account. But what they do is they buy non-performing mortgages from people, and it's a little bit of a social mission too, because their goal is to keep the people in the houses.
Okay.
So they buy them for 30 cents on the dollar from the banks. They renegotiate a new mortgage with the homeowner, and then they wait and let those mortgages, I guess, turn good again, right? So then they can sell them. And so that's kind of what they do. But if you park your money with them, they pay you 10%. And so any extra cash I have, I just throw in there, and then if I want to get it out,
How long does it take you to get it out?
It takes 3 days is kind of the baseline for the first 25%. If you want more than that, they say it could take up to 30 days. But I in my investor group, I know a guy who's put up to $300,000 in there and gotten it right back out. It just depends on their liquidity position. So if you're talking about smaller amounts of money, there shouldn't be any problem getting it out. So I'm just starting with that, so I haven't taken any money out yet. But one of the things I'm doing when because I'm going to have a capital gain from the sale of my 22-unit property, and I'm not going to have to pay taxes on that till next April. So I'm going to take however amount my accountant says is what I'm going to owe on that. I'm just going to put that into this AHP servicing, have it earn 10%, because I'm going to have it for about a year before I have to pay it. And that way that'll reduce some of my capital gain, because I didn't do a 1031 exchange. We talked about doing a qualified opportunity zone. I may do some of that, but so I'm just going to park it there and earn some money while it's there.
Right. Neat. You talk about, I know you listen to some podcasts. Can you give us the name of some of the podcasts that you listen to? Where they talk about syndications, they talk about different opportunities, and we'll put these in the show notes as well.
Yeah, Wealth Formula podcast is one. That's the group I belong to, and that's the meetup I'm going to in Phoenix. It's a really neat group, because this guy Buck Joffrey, he used to be a doctor, brain surgeon, plastic surgeon, but he found out he was making more money investing, so he doesn't do that anymore, and now he's an investor. And he goes and he finds all these deals, and deals come to him, and I'm sure he gets a cut of them, and that's fine with me, because they're really neat deals. He has a lot of high W-2 people, so he finds opportunities for them to reduce taxes through there's an oil and gas deal that he found. There's land conservation easements. So there's a lot of different things. But he does a lot of these apartment buildings, and he has a lot of different ideas. He's not really a single family home guy. He doesn't like the turnkey stuff, but he's really knowledgeable. He also has a podcast on Bitcoin blockchain stuff, which is kind of a side thing that I'm not really into. But
that's still happening. I thought after the crypto crash,
he calls it crypto winter, and so he hasn't done a podcast in a while because no one cares about crypto anymore. But once it gets going again, he will. So that's one I listen to.
Hibernation.
If it gets going again.
Yeah. I listen to the real estate guys. they have a syndication seminar, and that's where I met a lot of these people. I went there thinking I'm going to be a syndicator, which I kind of did a little bit of, but what I would like to do and why I would go again is to meet people that are doing syndications. That's how I met a lot of these people that I've invested money with is from that. I also listen to Bigger Pockets, which I think a lot of people listen to. I listen every week to Take Action Real Estate podcast.
Absolutely. It's the best one.
Yeah. And then there's, what's the one, Get Rich Education. He doesn't do much syndication. That's
Kiyosaki?
No, that's, I forget his name, but he does mostly single family homes, turnkey stuff. And then the last one is, it was Narada Investments is the name of the company, but the Passive Real Estate, I think, is the name of the podcast with Marco Santarelli.
Okay.
That's a pretty good one. He does mostly single family homes. That's who I bought my single family homes through or found the turnkey providers. But he also is the guy who's doing the marijuana in California and Oregon that I did the loan on. So I think the more podcasts you listen to, the more people you meet. And then if you actually go to some of these meetups and just bite the bullet and pay the money and go, then you start meeting people and you realize that it's a very small world. All these people end up knowing each other and are connected in different ways. And you can meet a lot of different syndicators that do a lot of different things. And that's how I've met these people. And then, a few of them I just took a chance on, invested with them. It's paid off so far. And then they know 3 more people they introduced me to. And so you kind of build a network of people that, that's what Buck Joffrey, like, and trust. That's what he always says. And I think that's, a lot of people are saying that now. If you can find people that like, and trust, that you can do business with them, you're a lot better off than if you don't know them or you're again, buying stocks in the stock market.
Right. I mean, Phoenix must be a hotspot for syndications. I was just talking to another investor at our meetup last week who he was doing a syndication in Phoenix. And then also like Ben Leibovich, who used to be here in Ohio, he kind of runs a syndication out there as well. So interesting. Yeah. Well, good. Have a great trip.
Thank you. I will.
Do you, sorry, go ahead.
I just, nothing. Go
Do you have anything else that you want to add before we close up here?
I don't think so. I think we covered everything. I think that, as far as real estate goes, I just really believe that everyone ought to have some opportunity to invest in real estate and some opportunity to get out of the stock market. I know I talk bad about the stock market, and I think people should be invested in it. That's fine. But I think, if we can, through podcasts like yours or avenues like that, just to educate people that there are other ways to make money, and that in retirement, it's critically important to have income producing assets, not just random assets, but they have to produce income because, Social Security, your pension, all that stuff may or may not be there for you. So, people that are trying to build wealth need to think outside of what everybody else is doing and do something else. So I think podcasts like yours and the other ones we talked about allow people that have, regular W-2 jobs to also participate in real estate. So that's what I'm trying to do is the people that I know and former clients or current clients and other people that want to invest in real estate, I'm just trying to help them out and then, figure out how to get paid on the other end or not, but just to help people learn how to do what we've been doing, I think is important. So
right.
I mean, I think that's what we don't get paid to do this podcast, but we actually spend a fair amount of money to get it done. And we just enjoy sharing our knowledge, introducing people to other people like you, and seeing people just get out and take action towards their future, towards, the freedom of their time. I always, one of my relatives passed like a certification exam for nursing. And one of the comments my family made was, now she's going to get a $2 raise. And I just was thinking, $2. I mean,
yeah,
I have a hard time thinking like that right now. And I have a hard time being excited for her because she's just going to change. And she loves what she's doing. She enjoys it. So that's fine. But, financially, it's not going to move her forward much.
Right. And I really like what you say, time freedom. I mean, that's what we all want, right? I now have some time freedom because I have freedom from a 9-to-5 job, and so do you guys. I know you guys work hard, but that you could also take time off, and I think that kind of freedom is what you want. And I don't necessarily think you can get that just by following the path of everybody else, going to college, getting a job, retiring. That's not time freedom to me.
Yeah, I mean, I always tell people you got to quit trading time for money.
Yes.
And I, we do that here. Obviously, you're doing that, but you're doing it in sort of an exponential way. You're putting a bunch of time in now so that you don't have to later.
Exactly. That's a great way to say it. I completely agree with that.
And it's never comfortable to do that. I mean, I think of us, the way we got out of kind of trading time for money is hiring the right employees, and it's never comfortable to do that. And it's not always comfortable to, put your money in an investment where you're going to get 10 or 12% because there's some unknown there.
In a different country.
Yeah.
Yes.
In a crop that could fail. But it's just a risk. I mean, but the return outweighs the risk. And so the potential is there, and like you diversify. You're in a lot of different areas and arenas. Yeah. So if one of them doesn't do well, you got a backup plan.
Yeah, that's my hope.
And that's why we call it the take action real estate, because I feel like the only way to truly fail is to give up, because you hire an employee, it doesn't work out, you learn something. You invest in something, doesn't work out, you learn something. And unless you give up, you're going to keep learning until you're successful.
Yeah.
I completely agree.
Really glad you came back. Had a good time chatting with you.
Yeah, thanks for having me. I'm glad to be here.
Yeah, I love the message. Really appreciate you being here, Jim.
All right, thanks
a lot.